here on Tuesday, the 26th day of November, 2013, and this is the daily report for gold and silver. Following a better than expected housing report here in the United States, we do have the precious metals once again under pressure, with gold currently trading off approximately $10 on the day. The low on the day is a $1238.90 and the high $1256.50. You can also see the same kind of decline coming off of these highs right here. These highs are 2032. We're currently trading off about 40 cents on silver, almost 2% lower on the day. 1974 on the low, and our current print is 1981, so we are trading just off the lows in both gold and silver. So before we take a look at this most recent fall, I wanted to make some sense, some technical sense that is, of the most recent clip up. And the clip up that I'm speaking about is we saw intraday lows that we haven't seen really since market went to 1181. We haven't seen this price, and that was 1225. We're looking at a 60-minute chart, a straight candlestick chart, and I've basically put in one fib retracement from just under 13 to this low of 1225. And I draw our attention to the 50% retracement level. That's the level that lines up the closest in terms of plotting this particular intraday high that we hit. This intraday high comes close to, I believe it was around 57 or 58. You can see that high right in here. But as this market really has this solid decline, what we notice is that we get it gives back approximately 50% of this decline down and then begins on its southward trail, currently trading, as I said, 1240 in that area, and 1240 to 1236, as you know, is a fairly significant number. We'll talk about that on the upcoming charts. You know, we talked about the fact that the 1225, that particular number, in terms of finding any kind of historical precedence, we really had to go back to a weekly chart. The weekly chart had to take us back, I believe it was 2010, because that was really the last time we have seen the market at 1225. And as a technician, what I'm looking to do is to see price points in time and to compare how the market reacted at those price points to today's most current circumstance. 720-minute chart, standard candlestick format, and we have one fib retracement that I'm going to be using on today's show, and that fib retracement really starts down at 1181. It takes us to 1435, so it truly encompasses the largest rally we have seen in quite some time, this couple $100 rally. When we do that, and then we look at the 76% retracement, the final retracement level of that takes us to approximately 1240. So market is trading just above that area right now, but I deem this to be a fairly critical area. Once, or if it breaks through this area, we do have this new support level at 1225, but as you'll see on the next chart, historically speaking, there's only one reference point in time in which we can even look at it, and it was a resistive area and not a supportive area at that point. In fact, let's go ahead and pull up that weekly chart. Looking at a weekly chart, standard candlestick format, but they're too compressed. We're really not looking at the candlesticks right now for any kind of information. I have simply put in a horizontal line, and the horizontal line that I put in, I based upon this low of 25 and then looked back historically to see if there were any points that matched in time. And as you can see, we have an entire void really until we get into this particular area between the end of 2009 and maybe the end of 2010. Now, when we look at it, as the market moved through this area, there's really no information that we can derive. It's not really supportive or resistance. It pops on top, then it pops below, and then it breaks through kind of solid. However, we do have one point, and that point is right here, in which as the market was trading, and if we go back in time First of all, let's look at that 1,000 marker, because that 1,000 marker was so very important back in 2009. Gold had never really gone to that point. You can see that it hits this point, but from this point, it trades back down to about $700. Here comes up, and then here we get that low a little bit below 700. And as it does come up, we get more resistance here. And so you can see that this $1,000 point was absolutely solid resistance throughout this area. But then it does finally break above that particular price point, and does so with a fury, with an absolute fury, but it stalls right at 1225. And so that particular price point, in terms of having technical evidence, meaning a time when we can derive or glean some sort of information, this is really the only spot that we can do that. Market comes back down, it flirts with this area, and then just breaks away. And at that point, we've got a runaway train, because we're going into our parabolic moves as we hit these record highs above $1,900 back at the end of 2011. Now, one thing that I can say, when we look at the big picture, this is a daily chart. I've really compressed it so that we could see the 76% retracement. This is a retracement from about 1050 to the record top. And the number that we get is 1249. And of course, the market is trading below that currently. So I think that that is really important, because that to me should be some sort of major support if the market is going to in any way hold these particular areas. I am still looking for lower prices. We are still short the market. We will be trailing our stops up later on this afternoon. The deciding factor is not if we're going to trail the stops, but really what price point makes sense. And I'm looking at recent highs in the market and ascertaining where we think we can be protected, lock in profits, but yet cover any kind of intraday volatility within the market, so it doesn't knock us out on a stop on the high, so to speak, and then kind of drift lower. That's, of course, the double-edged sword we always face when we're trading. However, when we look at this particular chart, and let's go ahead now that I've established where that particular line comes from, and we can actually go ahead and blow that up. When we do that, what you'll see is this. I still firmly believe that we are currently in wave 5. I also believe that in terms of our sub count, we are in wave 3 of 5, and that gives us a certain distinction, because wave 3, in terms of Elliott wave theory and strategy, cannot be the smallest of any of the impulse waves. The fact of the matter is also that wave 1 typically is our benchmark wave. We use wave 1 to basically determine how long wave 3 is going to be. It can be anywhere from equal, but typically 1.61% is a number that we use. That would take us far below the recent low, so I'm not really looking for that type of a dramatic wave. I think we've already seen that dramatic wave with this long wave 3 right here. This was an incredible wave, or move down, of course, because we saw the market fall out of grace literally from $1,800 to move down. But I do think that there's still dynamically an opportunity for the market to retest this 1181. And of course, we're in at about 1270, mid 70s, and my sense is that if we break below 1200, we've got a great trade to kind of exit the year on. We're in profits overall on the year. When you consider the fact that gold is down, 25 to 30% for the year, and we've got, anywhere between 150 and 200% profits, we have been fortunate this year in that we have kind of stayed on the sidelines and now are kind of making a couple of short plays, but we've taken advantage of the market moves as they have really unfolded to us, and we've been able to use our technical indicators to kind of create the models necessary to have good, profitable trades. I'm really pleased with their performance this year, more so because this market has gone through so many peaks and valleys. It has really been a dynamic market and a tricky market to trade. 2009, 2010, 2011, those were markets that you really had the opportunity to make tremendous profits, and we did, but we had a runaway market that was truly trading basically to the upside. Then we got into a scenario, and to really illustrate it, I'll go ahead and pull up our weekly chart, but then we got into a scenario where we had a market that was defined by a large range, but a range nonetheless when we consider that we had these lows at around 1535. We had our highs now because we never ever really achieved 1900 once that hit and came down. But we had this series of tops here at 1800. We were able to, catch these trades to the upside and get out to the downside. This was a really good trade to the upside. And of course, as this market came down, honestly, we really believed that once it broke through here, we would see some really strong, dramatic drops. We did get that drop. And when we look at this marketplace as it sits now, we can see where it could potentially find support. And this is the area of the 76% retracement of this large move. We talked about that earlier. But as I said, because of the current wave count that we have, as long as we remain in a bear market, and traders, there's no doubt this is a bear market, we're going to maintain our bear count. And as long as the market unfolds with the bear count, really in terms of our intermediate count, what we are looking at is 1, 2, 3, 4, and then this being 5. 5 as a flat would take us to the most recent lows, and as what's called a standard zigzag would actually have a low below 3. In other words, you would have a new low that really comes below that 1181. And traders, if we get that, we're going to be prepared for that, of course, and we're going to look to create opportunities through 2014, the end of 2013, that will continue our track record so that we can go into our 4th year of positive gains for our subscriber base. And that's what it's all about, and that's why I wake up every morning and do this report. That's my goal. Now, as far as silver goes, we have been looking at tandem levels. So just as that 76% 1240 in gold has been a level that we identified as a necessary level to hold, we have a reciprocal or a very, very similar scenario in silver, and that's based upon the rally from 18 to 25, which corresponds, of course, to 1181 to 1435 in gold. Those happen at the same time. Market comes down. We have a 76% retracement level. Now, with gold, we're trading just at it. We're looking at currently 14 or 12. Markets change so often, but 1240 to 1242, and 1240 in that area is that 76% retracement level. Now, if it breaks through that retracement level, I'm looking for it to go to the lows of 1181. In the same way, if we break hard below 1967 on a closing basis and start to trade under pressure, my sense is we're going to retest this low at $18 in silver. For that reason, my recommendation currently is to maintain our short positions in both gold and silver. And as I said, we'll look to trail our stops in both. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Wednesday, the day before Thanksgiving, and our final update for the week.